Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and this is a daily candle chart of the CBOE Market Volatility Index, ticker symbol VIX. I'm starting off with the VIX to show you this very long stretch of red right here. We have 9 red candles in a row. Count them right through there. Still heading towards this record low support level down here around 14. But the reason I'm starting again with the VIX is because this is known as the fear index. So when fear is dropping, you could also say that investors are getting more complacent. Now, what does that mean in reality? Well, investors are relaxed with their positions. They're not really buying too much more, but they're not selling. They're certainly not panic selling. So the volatility index continues to drop. Now, look down below. You can see that the CCI down here is showing a positive divergence. You see that? On this low right here, on that big red candle, the CCI registered a low. Now that we're at a lower low on the VIX, the CCI is showing a higher low. And not only is it showing a higher low, but it's showing a hinge to the upside. Now with that, you could also see that the Stochastics is as low as it's most likely going to get. This is on a scale from 0 to 100, and we're way down here at the bottom of that indicator. So that's an oversold condition. We have a wide divergence from that moving average. And so very little has changed with the forecast for the VIX here, because week after week I've set this in place so you can get an eye on where I think this is going to go. And last week what I did is I took the Fibonacci retracements and drew this resistance line. You can see that that resistance is right around just below 29. And I drew the Fibonacci's, and that's pretty close to the 61.8 pullback. So I'm leaving that in place with my longer term target for the VIX at 27.31. Now I said I would leave that Fibonacci retracement tool on the charts for this week, but now I'm going to erase that to clean things up, leaving that exactly in place. Option traders, if they're looking for a pop, will most likely buy calls on the VIX. You could also look to buy puts on the S&P or do put spreads, or if you have any long stocks within the S&P 500, you could sell out of the money calls. There's a lot you can do when the volatility index is low like this. But remember, my main theme is risk management. I'd rather be early on my call to the downside than late and have everyone missing out from protecting their profits. You know, the key here is if you're at long stocks that are moving up, move your stops up, protect the profits, and then be ready to reverse positions. Now, with that said, I'm going to go to the SPY right here. Ticker symbol SPY. I left the Fibonacci retracements online. Again, there's nothing I'm changing here. I'm keeping that. And for those of you who think I'm a perpetual bear, understand that I'm not. I call bottoms as well as I call tops, and I've called tops very accurately. Most of the time I'm early. Again, that's intentional to make sure people are moving out, because even when I'm showing the signals of an overextended market, it takes people a lot of time to separate themselves from long positions. It's more of an emotional, psychological thing. Read Investment Psychology Explained by Martin Pring, and you'll know exactly what I'm talking about. Martin is a good friend of mine out of Sarasota. He and his wife, Lisa, have been involved with the markets for many, many years. He's a great author. By the way, I get nothing to promote his books. I just think it's good content. It's great for your library. And if you like, I could put a link below to his website. Now I'm going to erase the Fibonacci retracements right there, leaving this target in place. Remember, this level right here, that's the first level of support. We already hit that back here. I'm leaving that in place because it hit, it held, it may hold again, but if it breaks, boom, right down to the 410 level, and we're going to have to keep our eyes on that. So that's SPY. If you look at the Qs, QQQ more or less represents the tech sector. Again, leaving my lines in place. I will erase the Fibonacci's and show you exactly where the pullback point is right there. 38.2 on the Fibonacci is what I'm calling for, and that leaves that horizontal line right there. Notice one thing. You could almost feel the market stalling at this high, right? It bumps its head against this resistance. It pulls back. Today, we went up just a little bit, But then notice the volume drop. You see this? We have a drop in volume on the way up. That's a negative sign. And also the CCI is showing a negative divergence right there, right? We're still showing lower highs, and that's something you have to pay very close attention to. I often mention Don Lambert, who's the creator of the CCI, would often talk about the negative divergences and how powerful that is. Positive divergences also work very well if you're looking for buying opportunities, but you would have to see higher lows on the CCI when the price action is going to lower lows, and we certainly don't see that right now. Now, if we look at the diamonds, DIA, right there, you can see again, I leave my lines in place. Nothing's changed. We have this support level down here at 346.52. Notice, again, the Dow was up oh so slightly, but look at that CCI, look at the stochastics, still turning lower on lower volume. So again, nothing changes on that chart except for the fact that you need to continue to raise your stops as the market goes higher if you're long. Again, trailing the stop is a great way to protect profits and often prevent a catastrophic loss. Okay, so that's for the diamonds. One thing I'd like to leave you with here before we go is a chart of the shipping container rates. If you take a look at this, these are still going through the roof. And I'm not sure if any of you got the news about China shutting down its main shipping ports, or at least 2 of them. That's only going to increase the rates at this level as our supply chain gets poised for another crunch. That's number one. So keep an eye on that. And if you look down at the bottom here, you can see the University of Michigan Consumer Sentiment Index, very accurate. You'll notice what's happening down here. This index is plummeting right now. See this? Now, this goes back to 2010, so we have just about 11 years of history here, and we are rapidly approaching the 10-year lows. And when you have consumer sentiment starting to drift like that, or as I said, plummet, you're going to have people holding back on their spending. Maybe they feel that there's going to be another shutdown down the road. We don't know that yet, but ultimately that could most likely affect consumer spending, and it could affect eventually tax revenues generated from sales. So what I'd like to do is in the description box, I'm going to leave a link from my report that I put out in March, the end of March of 2020. So you can see how back then we had enormous buy signals coming up, and what we're seeing today as compared to what we saw last year is the exact opposite. If you like to take the time, it's about an hour long on that video, but you're going to get a lot of lessons on how to read the charts both from the upside and the downside, and giving you some ideas on how to protect your profits in the middle. So have a great weekend, and we will talk to you soon. So long.